Aging is a part of life, and it is one that many do not want to think about or consider um, until typically you get a lot older, or at least closer to getting a lot older. But it is something that I think a lot of folks should be thinking about, at least partly whenever they're doing their financial plans, as the cost can be substantial. So I'm talking about kind of the last phase of retirement. I typically think about retirement in three phases. You have your first phase is kind of the young and fun phase. You might retire early. Some people maybe in their 50s, some people in their 60s, but typically you're young enough and healthy enough to be able to go do things, travel, see family, uh, all the things that people think of when they retire. They think of really phase one. Phase two is the kind of slow down phase, and so you got a little bit older. You're still healthy, but you don't need a ton of help. You're still able to do things around the house and do just kind of regular everyday activities, and that's fine and well. And then the last phase is really where you are no longer able to do things for yourself. And so that's where typically you might see people get some help from nurses or move into some sort of assisted living facility um, or things of that nature. So that last phase really can be one of the most expensive phases, though, as it costs a substantial amount to have professional help, and typically professional help might even be needed 24 hours a day, 7 days a week. And so when you're looking at those potentially substantial costs, 50, 60, $100,000 or more a year just for the care itself, not even included just the regular living of food and paying utilities and all those things. So that last phase can be very expensive. So then the question becomes, well, how do you pay for that, or how do you plan for that? And many people say, well, I'm not going to plan for that. If whenever I get there, I'll just tell them to unplug the plug or whatever. And while I certainly understand that, in reality, it just doesn't end up working out like that, because oftentimes it's a slow fade into that, and then once you're there, it's really not your decision anymore. It's your family's decision, and obviously, and many times families are wanting to, um, make sure everybody's healthy and happy, as at least as healthy and happy as they can be. And so, how do we play? How do you pay for that? Well, the first option is self-pay. Self-pay is basically, hopefully you save enough throughout your lifetime to have saved enough money to be able to pay those extra costs, whatever they may be. And they can be substantial, but that's where then you are able to use your IRA or 401k or mutual funds or stocks or what have you. And you just pay the money out of pocket yourself for whatever amount of care you need. And that is a fine option if you can afford to do so. And I find a lot of people do, especially if you're a Disney cast member. A lot of those folks have pensions that are at least retiring here. More recently, those that are younger may want to think about saving extra to pay for that self care. Even sometimes using things like a health savings account might be a decent idea as well. The second option is using some sort of insurance type product to pay for the long term care needs. So, long term care insurances fall into different categories. The first one being long term insurance, just a traditional insurance, which basically means you pay an annual or a monthly premium and you get a certain amount of benefit. And that benefit usually lasts for a certain amount of time. Sometimes older policies last a lifetime, but not all policies do that. So most of them last maybe 2 years or 3 years, or depending on how many. And there's a bunch of different bells and whistles you can add to that. But in essence, what it does is you're paying that annual premium, and God forbid, should you need it, it's there and would cover you for maybe however much coverage you got. Could be a couple $100,000 or something of that nature. Um, then the other type of insurance is kind of what they call a hybrid approach, where they're tying life insurance, typically it's whole life or universal life insurance, with a long-term care product. So if you think about life insurance, life insurers started getting into the long-term care business because they are insuring against 100% of people are going to die. So their numbers are based on 100% probability of happening, right? Well, they are looking at the long-term care market. A lot of long-term care insurers got in trouble because of their math and numbers and actuary tables and all of that stuff didn't really quite work out. So a lot of people have gotten out of long-term care insurance business, but life insurance companies started stepping in, and they have the option where you can pay either an upfront lump sum or maybe annual payments for 10 years or even for your lifetime. But there's the nice thing with these hybrid policies is that some of the cash value is there to use if you need it. You can pull that cash value out, or if you don't end up using long-term care insurance, then your beneficiaries still get a death benefit. Now, usually it's a reduced death benefit, but there's still a death benefit nonetheless. Versus that traditional model, you pay the insurance, and if you never use it, then it just goes away. The insurance company is taking all of the money, and you get really nothing to show for it. Which is fine, I think, because it's protecting against a risk. We use insurance to protect against a risk, even though we may not hopefully ever need it. So the hybrid insurance policy is usually tied to some sort of life insurance, and gives you more options than just paying for long-term care. Another third option for long-term care insurance type product is what's called an annuity with a long-term care rider. So basically, this is an annuity. Annuities are basically issued, by insurance companies, and they are usually will give some sort of guarantees. Most of the time, annuities will have some sort of guaranteed income or guaranteed growth. But in this instance, they're going to give you some guarantees around long-term care insurance. So if you have the need for long-term care, then you maybe are able to get some additional monies above what you put into the contract. Now, annuities have a really bad rap, and in many instances, possibly rightfully so. So there's a lot of bells and whistles, a lot of moving parts to those. They're very complicated contracts that you want to understand before signing up for really any of those options. But there are options if you want to say, hey, this is a risk that I think might happen, and I want to offload that risk to pay the bulk of that risk to somebody else, i.e. an insurance company, rather than having to take the onus on myself, because the odds of having some sort of aging long-term care event are pretty high. I've seen numbers, once you're over 65, I've seen numbers really one of 3 people are going to have some sort of long-term care need. Now, to the degree and amount of time and all of that certainly can get in the details really quickly, but nonetheless, it's a pretty high likely event. So the insurance is nice because you can then offload that risk to another company. The downside, of course, is going to come at some sort of cost, and you have to evaluate, is this cost really worth the trade-off or not, and all of that. And so there's some consideration there. Another option is Medicare. Medicare only, though, pays for really up to about 100 days of long-term care, because Medicare is a type of traditional insurance that's just offered through the government, and that Medicare coverage is really only meant to get people healthy. And when you're in these long-term care events, there's really no prospect of you getting healthy again. It's you just need care for an ongoing basis, and usually it's for things like going to the bathroom or restroom or getting dressed, all of that stuff. And so Medicare covers up to 100 days, but then thereafter, if you still need care, then they stop covering, and that's when you have to go to one of the top 3. Or the last option for covering that care is Medicaid. Now, Medicaid is the insurance program for basically the poor and destitute. So you have to have less than $2,000 of assets in the state of Florida. In other states, there's different rules. But anyways, it's pretty much you have to have very little assets, very little income, and the state will then pick up the cost for that care. And usually what they'll do is they'll take all of your income sources, so maybe you have a Social Security and a pension, and then whatever the difference is, they'll kick in on top of that. And so Medicaid will come in, but you have to basically lose all of your assets or get rid of all of your assets before that time. And so, except there's a couple caveats. You can keep your house and you can keep your car as well, of course. And about $2,000 to your name, and anything above that would have to be used to pay for the long-term care until you no longer had it, and then Medicaid would kick in. So there are several different options as far as paying for that aging care, and it's good to understand it and think about it while you're young enough to be able to do something about it. This is something you typically don't want to be thinking about, as you're getting closer to the event. Hopefully, you're able to plan for it, save for it, a little bit over a long time ends up to being a good amount of money that you can save or put away to cover those costs. Now, long-term care in general is able to kick in, or you need long-term care whenever you are able to do or unable to do daily living activities, usually the first 30 minutes of your day. So getting out of bed, getting dressed, taking a shower, going to the restroom, cooking, those things of that nature. And then, or a cognitive disease, Alzheimer's, dementia, what have you, also qualifies you without having to have two of those things. Usually you have to have two of those things for it to qualify for long-term care insurance. And so a lot to consider towards the end of life, and aging and all of that. And those are just how to pay for it. There's a lot of other considerations as well, as far as what type of care you would want, who would be providing that care, who's going to be responsible for coordinating it, and the list goes on. So I hope you found that helpful. My name is Kyle Newell. I am the owner of Newell Wealth Management, a fee-only financial planning firm here in Winter Garden, Florida. I serve clients throughout the Orlando area, face-to-face or virtually. And of course, I can work with people pretty much all over the country virtually as well. And if you did find value in that, I would love to meet with you. Or if you have a question, drop a comment or send me a message, or give me a call. My website is newellwm.com. So NEWELLWM.com. And I'd be happy to, you can use that website to set up a time to meet with me. Of course, this is all just general educational material, nothing specific or no specific recommendations. You want to talk to your own financial advisor. If you don't have one, you certainly can talk with me or your own tax planning expert, insurance person, all of that, because this is just general information, so that you can hopefully have an idea of some different strategies to use. But again, no specific recommendations for any specific person. So I hope you have a wonderful day. Thanks again for your time, and I hope you have a great day. Take care.